Hello and welcome back to the Geordie Pig Investor channel. Today we are going to have a look at, is ASML Holdings stock a buy right now? What is ASML Holding? Stock ticker ASML. It engages in the development, production, marketing, sales, upgrading and services of advanced semiconductor equipment systems. The firm operates through its subsidiaries in the Netherlands, United States, Italy, France, Germany, the UK, Ireland, Belgium, South Korea, Taiwan, Singapore, China, Hong Kong, Japan, Israel and Malaysia. Let's have a little look at some key stats to do with ASML. They are based in the Netherlands, are in the semiconductor industry, have a market cap of 247 billion. They went IPO in 1995. They currently have over 29,000 employees, have a dividend growth streak of 1 year, a 5-year dividend growth rate of 33.61%, and a dividend yield at 0.97%. As we can see on the graph, over the last 6 months, they have performed very poorly, being down 25.71%. And in today's video, we are going to have a look at, is ASML Holdings a buy, hold, or sell right now? ASML earnings call and fundamental analysis. In the latest earnings report, the company reported net sales of 7.5 billion euros, surpassing expectations driven by robust DUV sales and a thriving installed base management sector. Looking ahead, Q4 is forecasted to see sales between 8.8 billion euros and 9.2 billion, with gross margin estimates between 49 and 50%. For 2024, the revenue is projected at 28 billion euros with a gross margin of about 50.6%. However, due to changing market dynamics in 2025, revenue expects to have revised to only 30 to 35 billion euros, reflecting a decline in low NA EUV tool demand. Despite the current business dynamics, the long-term growth drivers appear solid, particularly in the AI and electrification sectors, which are expected to underpin demand. The company remains committed to capital expansion to meet increasing global demand from new fab openings, maintaining optimism for future performance as the semiconductor market evolves. If we have a look at the fundamental analysis of ASML, we can see they currently have a positive free cash flow at 3 billion, positive net income at 7.4 billion, positive operating income at 8.7 billion, positive gross profit at 12.9 billion, exceptional ROE at 51%, very good short and long-term solvency, an extremely low debt to equity at only 0.26%, a very high Altman Z-score at 10.44, high interest coverage at 51.88, and negative net debt, which is very nice to see in a company at negative 410 million. Very promising signs, and we're going to have a look at their free cash flow position and how it has been over the last 10 years. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on the direction a company may be heading, because if a free cash flow is in the negative, the company is likely going to be regressing and unlikely to pay those dividend payments. From the graph, we can see that ASML have grown their FCF by a considerable amount since 2014. It has dropped off over the last couple of years, but in maintaining a healthy capital allocation strategy, the company plans to sustain dividend growth with interim dividends already projected at €1.52, alongside share buybacks when cash flows are favourable, which means their overall FCF may dip slightly, but it is still in a very strong position, and by allocating the capital elsewhere should benefit the company in the long term. They currently still have a very healthy free cash flow ratio at only 35%, which means they have got a good scope to continue to hike the dividend over the coming years. Next, we're going to have a look at ASML's discounted cash flow valuation. The DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on selected operating models. ASML's current price is €632.90, and on the worst case scenario, with an 8% discounted rate and a negative 1.7% terminal growth, we can see that they will be worth €214.51. On the base case, with a discounted rate at 7.6% and a terminal growth rate at 0%, they would be worth €448.16. And on the best case, with a 7.2% discounted rate and a plus 1.7% terminal growth, they would be worth €667.19. Not only do I look at the DCF valuation, but we also have a look at something called the relative valuation. The relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics it includes is EV to revenue, EV to EBITDA, and PE ratios. When plugging in my numbers on the worst case scenario, we can see that ASML will be worth €659.87, which is an undervaluation of 4%. On the base case, they will be worth €931.09, which is an undervaluation of 32%. And on the best case, they would be worth a whopping €1,118.41, which would be a 43% undervaluation on that current price. From this, we can then come up with something called the intrinsic value. The intrinsic value is the combination of the relative valuation and the DCF valuation. This is a method that's been used for many years by many different investors and one that I find fairly reliable when calculating my dividend stocks. On the worst case scenario, we can see that ASML Holdings will be worth €437.20. On the average case, they'd be worth €689.63. And on the best case, they'd be actually worth €893. Finally, I have another valuation method that I use when calculating a company, and that is the Wall Street estimates. The Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that leads to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. A company the size of ASML, like most of the companies that I cover on this channel, is going to have multiple analysts looking into that company. There's not just going to be one person who's dictating the potential price targets for this company. There's going to be multiple people looking every single day and coming up with these different price targets. On the worst case scenario, they would be worth €656.50, which is a 4% upside. On the average case scenario, they believe they'd be worth €872.50, which is a 38% upside. And on the best case scenario, they believe they'd be worth €1,155, which is a massive 83% upside. So what does this mean for the company? Now that we have all three valuations, I can combine them to get my final best, average and worst case scenarios for ASML and see if it is currently at an attractive price. On the worst case, ASML would be worth €510.30. So with a 10% margin of safety, you'd be looking to buy at €459.27. And with a 20% margin of safety on the worst case price, you'd be looking to buy at €408.24. On the average case, we can see ASML will be worth €750.60. So with a 10% margin of safety on the average case price, you'd be looking to buy at €675.54. And with a 20% margin of safety on the average case price, you'd be looking to buy at just over €600. Then when we look at the best case scenario, we can see ASML will be worth €980. So with a 10% margin of safety on the best case price, you'd be looking to buy at €882. And with a 20% margin of safety on the best case price, you'd be looking to buy at €784. Well, what does this mean for ASML Holdings? Is the stock a buy right now? I think right now ASML is nearing an extremely good price to buy. They are very close to that 52-week low, which is €605. This is due to some short-term turbulence in certain areas of business, but other areas are still excelling, and I think when taking a step back and looking at the bigger picture, they are still an exceptionally well-run company with very strong core fundamentals, which I highlighted in the fundamental analysis earlier in this video. This is a very well-established business that has a track record of not only paying and growing their current dividend, but also having a healthy FCF that is only going to get better year on year. Their high dividend growth, over 33% over the last 5 years, only leads to a stronger case for potentially owning the stock in your portfolio, as this will lead to great growth over the long term. Price currently is hovering around that 15% margin of safety on my average case price, which I still do believe is great value. Is this a stock you currently own in your portfolio right now, or is this a stock that you may be looking to add into your portfolio? Let me know in the comment section down below. I hope you enjoyed today's video. Please let me know of any other stocks you want to see a full breakdown on. Thanks for watching. Please like and subscribe. This is the Geordie Pig Investor, over and out.